Hi folks, Nick Colantuono, Certified Financial Planner here with Johnson Brunetti, and welcome back to our Money Wisdom question series. I'm loving today's question. It could not be more relevant, and in fact, today's question is all about risk. The question is, how can I protect my retirement savings against stock market volatility? Well, let's unpack it, folks, because at the end of the day, when you're retired, let's face it, the reality of your financial situation, or at least your retirement savings, is likely all the money you have is all the money you'll have. So growth is certainly important. We need to keep pace with inflation. We need to make sure that this money that you've worked so hard for is going to continue to work as hard for you as you've worked for it. But we also now need to make sure for our clients that it'll last as long as they will. And that's where safety, security often becomes the bedrock, the foundation of the financial plans that we're building for our clients. So how do we do that? Right? There's a lot of different safe, secure vehicles that exist out there, the most common of which is just cash, right? Cash inside your retirement accounts, cash inside your IRAs, cash in the bank. And while it provides you with safety and security, one of the biggest concerns with cash is that it does not do as good of a job as it should with keeping pace with inflation, keeping pace with the fact that the world we live in is just getting more and more and more expensive every single day. So cash is an option, and right now cash is not the worst thing in the world, especially if the market's falling in value. It's a common way that we're achieving some level of safety while also providing liquidity and a small, reasonable rate of return, somewhere in the 4 to 5% growth rate for our clients. But cash is not the be-all and end-all. There are other vehicles, whether they're CDs, where you're getting a fixed rate of interest, certain types of insurance products like fixed annuities, where you're making, yes, a time commitment similar to a CD, often a little longer than a CD, and instead of having your money with a bank, your money's with an insurance company. So they're willing to pay you in exchange for that longer time commitment, maybe a little bit of a higher rate of return. So we're seeing 3-year fixed annuities, 5-year fixed annuities, somewhere in the 5 to 7% per year guaranteed range. So something you should consider if you want a little higher rate of return than cash, and if you're also willing to make a little bit of a longer time commitment than traditionally a CD, where you're looking at 6 months, 12 months, maybe 18 months, right? The fixed annuity world, now we're talking 5 years, 7 years, or longer. Now, if you're willing to make an even longer time commitment, yes, in exchange for an even greater potential rate of return, this is where we're exploring other insurance vehicles like fixed indexed annuities. Now, again, a fixed indexed annuity, no risk, no fee, you'll never lose money. Your rate of return is not guaranteed every single year like it is with a CD or a fixed annuity. Your protection, right, your principal protection, that's where your guarantee is. Your rate of return is based off of the performance of an index. Think S&P 500. So if there's a year where the S&P 500 goes up, your fixed indexed annuity will go up with it. Now, of course, because of the principal protection that they provide you, you're not getting all of that rate of return. You get most of it, and in most cases, you get up to about 10, maybe 10.5% per year. But there are some years where you might get zero. Now keep in mind, folks, I always use the saying, zero is your hero. Zero does not mean you lost money. And in fact, if there is a year where your fixed indexed annuity does get a 0% rate of return, you're still pretty happy about that, because what that really means is everything else you have, at least everything else you have in the market, has gone down in value over that same 1-year period. So, folks, this is such a fantastic question, and it really hits at the core of what we do for our clients, which is obviously growing money. You need your money to grow. You need your money to work as hard for you as you've worked for it. But safety is key, because now when you're retired, you need to make sure that your money's going to last as long as you will. So folks, my name is Nick Colantuono, again, Certified Financial Planner here at Johnson Brunetti, and thank you as always for joining us on our Money Wisdom Question series.